Okay, your next homework assignment is due a week from today. Homework number 7. I think that is available now. I've posted that on Blackboard, so you can go in and get started on it today. There are several questions that have to do with bonds. And it's an important subject and something that I've noticed students need a lot of practice on. So I think actually the first 4 questions are related to bonds, and we're going to talk about that today. The other thing that we're going to begin on today is a method whereby we can calculate something called unrecovered investment balance. And like I mentioned at the beginning of class, there's a template file that's on Blackboard, and you should download that so that you don't have to spend as much time just typing in column headings and making the widths match what you're going to need. So kind of streamline our in-class exercises today to have that. All right, so to begin with bonds, a bond is a way that a company can raise money. And remember that we calculated the weighted average cost of capital earlier in the semester. And companies can get money from the bank, by selling shares, or by issuing something called a bond. And a bond is an instrument where you're promising the person who buys the bond a certain fixed interest, and then at the end of the period, you have to give them a lump sum. And so there's generally 2 parts of value in a bond. There's the part of the value associated with this steady stream of interest payments, and then the value of a lump sum at the end of the period. Here's some bond values that I got online today, and I looked up various companies. And the 3 components of a bond that are important for us to talk about today is the coupon percentage, the yield, that yield should be percentage, not dollar. So yield percentage, and then the price. And so in this data, the coupon is what the company promises to pay. And so for instance, if you buy a bond for $100 and the coupon is 1%, then what they're promising is that they'll give you $1 of interest each year. And so you can see that sometimes the coupon and the yield are different. And the reason for that is that bonds don't always sell for their original price. Most bonds, when they're first sold by the company, when they're sold to the initial investor, they're sold for 100, whatever the units are. If it's Canadian dollars, US dollars, euro, whatever the case may be, the typical selling price for a bond is 100. But these bonds have very long time frames. Sometimes they're for 20 years or 30 years. And the person who originally buys the bond may not want to hold it for that entire period. And so there's a lively resale market where you can buy and sell bonds between third parties. And so I could go today and I could buy this AT&T bond, and it's not like I'm buying it from AT&T, I'm buying it from someone else who maybe had originally purchased it from AT&T. And although they paid $100 for it, the current price for that AT&T bond is $99.77. So there's lots of factors that can affect the selling price for a bond. For example, Chesapeake Energy. Look at the price for that bond right now, $61.15. And when the bond was originally issued, the people who bought it paid $100. So does anybody know specifically what might be going on with Chesapeake Energy, why their bonds are worth so much less now than they were when they were first issued?
Are they losing money?
I don't know if they're losing money, but they're not making as much money, or their prospects aren't as bright now as when those bonds were originally sold. When they were originally sold, it looked like Chesapeake was going to be a lot more profitable than they are now, and it's a risky investment. You probably have heard about hydraulic fracturing, fracking, and so there's a lot more supply of natural gas now than there was 5 or 10 years ago. There's kind of a glut of energy right now, and so some energy companies are struggling to make money because they spent so much money building up infrastructure, and now with a glut of cheap energy in the form of cheap natural gas, cheap oil, their profits aren't as high as they were in the past. And so I think that's probably what's happening with Chesapeake Energy, is that there's a risk that they won't be able to pay back the interest that they originally promised. They originally promised 5.75%. But the people who owned those bonds, some of them got spooked, and they thought, this is a little risky. I'm not so sure that Chesapeake Energy is going to be able to pay 5.75%. And so they sold their bonds, and there was so much pressure to sell the bonds that it drove the price down in the market. There was more supply than demand. And so when there's more supply than demand, the price of something decreases. And so more people wanted to sell their bonds, and what that did was that drove up the yield. So what it means is that if Chesapeake is paying $5.75 per year for every $100 of bonds that they originally issued, but I don't have to pay $100 to get that $5.75 per year. I only have to pay $61.15. And so it's like, it's not really 5% anymore. It's a greater percentage because you are paying less than the original purchase price. And then the other thing is, not only does that increase the value of those interest payments, but at the end of the bond, Chesapeake is going to give that lump sum of $100. And so it's like you're paying $61 now for $100 in the future instead of $61 in the future. And then the other thing about it is that you're not having to pay the full price to get this interest rate. And so when a company is doing poorly, the price goes down and the yield goes up. But now look how some of these companies have a really high price. So Wells Fargo. So it's the opposite story with Wells Fargo. Whereas Chesapeake is doing more poorly now than when those bonds were originally issued, Wells Fargo is doing better. They're on a more secure footing. So there's more demand than supply. And since there was more demand than supply, it drove up the price from the original basis of $100 per bond. Now the price to buy a Wells Fargo bond is $113. So what that does is that brings down the yield. Even though Wells Fargo is still paying 4.75% on the original sales price of $100, if you want to buy that bond, you have to pay more than the face value for it. So you're paying $113 to get $4.75 per year. And then also, what's not great about that is that what they're paying back, what the lump sum that Wells Fargo is giving people at the end of the bond, is only $100. And so you paid $113, you're only getting $100 back, and so it brings the effective yield down. So I know that that's complicated if you've never really heard about bonds or thought about the pricing of them very much, but the relationship is that you can see with each one of these, if the price is less than the basis, that makes the yield higher than the coupon. But if the price is less than the basis, the yield is greater than the coupon. So sometimes you can see this AT&T, the yield is higher than the coupon, although they're pretty close. Not a big difference because it's still relatively close to the original basis. So what you're going to have to do on some of these homework problems is find out how much is a bond worth today. And the way that you value a bond is that you find the present worth of the two components of its value. The two components are the interest payments and then the lump sum at the end of the bond's life. So here's the formula for how you find the value of a bond, and it's based on the two components, the present value of the redemption price. So at the end of the bond, the company will pay you back the original amount, and then the present value of the interest payments. And so think about what formulas we'd use. If it's a series of payments, we're finding the present value given A, where A is a uniform series. If it's some future lump sum, to find the present amount, we do find P given F. Now there's two different interest rates, and so this formula has two different interest rates built into it. R is the bond rate that the company is actually paying. So that's a negotiated rate at the original bond sale, and that doesn't change when the price goes up and down. The bond rate stays the same because that's all the company promised to give. The yield rate, though, does fluctuate depending on the purchase price. And so here the yield rate is I. That is the rate that we use to discount the lump sum to the future or the series of annual payments. So we're going to work an example just so you can get some initial practice finding the present value of a bond. And here's the statement. One thing that you need to know is that sometimes bonds pay interest more often than once per year. Sometimes bonds will pay interest twice a year, so that would be on a semi-annual basis. Sometimes the most common thing is quarterly interest. And so if a bond is paying quarterly interest, that means that every 3 months they pay out 1/4 of the annual amount that is due to their bondholders. So here in this example, it's a 10-year bond, and it says that it's paying out semi-annually. So what that means is if it's 10 years and semi-annually, there are 20 periods in the life of the bond. Okay, so the variable definitions, I've put in the blanks so you can just fill in the blanks as you're reading through this statement. Fill in the blanks and then use this equation, and of course the 4% table is what I've given you. And you may notice, well, wait a minute. It's the 4% table, but 4% isn't any of the interest rates in the statement here. That's on purpose. It's not a mistake that I've given you the 4% table. So read through it and think for a moment. I think you'll see why I've given you the 4% table and not the 6 or the 8% table. Okay, I've got the values that we're going to have to plug into the formula up on the screen there. Okay, so there's 20 periods because there's 2 periods in each year. So n equals 20. R is 0.03 because the rate is 6% per year, which is 3% per period. Same thing holds true for the yield. If we want to achieve a yield rate of 8% with this bond per year, then that's going to be 4% yield per period. And the redemption price and the face value are the same in this instance. And so C and Z are the same. Now I wrote a statement on the whiteboard here, and my statement that I wrote is the company pays 6% of $1,000 in interest each year. So that's $60 in interest they pay each year. That means it's $30 in each period. So what we essentially have, if we were going to draw a cash flow diagram of it, the company is paying 1, 2, 3, 4, all the way through n equals 20, and there's a uniform series of $30 for each period. So that's one thing that the company is doing. And then the other thing that the company is doing is this single lump sum, where F is 1,000. So these are the, like if you're going to draw a cash flow diagram, we want to find out how much should you be willing to pay now if you want to have the interest rate be 4% per period. So for I equals 4%, so a yield rate of 4%, how much should you pay to have balance between these 20 payments of $30 and the single lump sum of 1,000? So that's what this formula is calculating. It's finding the present value of those two things. And so it's the present value of the lump sum and the present value of the series of payments. Does everybody understand that? We're talking about two different components of the present value. So if we substitute that into the formula, then the yield rate is 4%, and we're trying to find out, what factor should we look up to find the present value of that future lump sum of 1,000. So we can look up the factor off of the table that's provided. Also the what factor for the P/A. So it's the $30 in interest each time. Sometimes you wouldn't even necessarily need to know the bond rate if you knew that the amount that it paid. They could just directly tell you it's $30 per period, and so $30 per period is R times Z together. So in any case, what this means is that if you want to have a 4% per period yield on a bond that only pays 3%, then you have to pay less than the original purchase price. And what that does is if you only pay $864 now, remember you're getting 1,000 in the future. So how do you get 4% interest if the company's only paying 3%? Well, you get the 3% from the company, and then the rest is because you're paying a low amount for a big lump sum in the future. So it's kind of like the difference between the yield and the rate is paid by the person you're buying it from. If you're buying it from someone at less than what they paid 1,000, you're only paying 864, then your return is going to be better than theirs would have been. What they get, if they hold that bond the whole time and they paid 1,000, their rate of return on the bond would be just the face percentage of 3%, the 3% bond yield. But you are going to be making more if you get that same return that they got, but you pay less. If your purchase price is less than theirs, then you're going to get better profits. Okay, so that's your first taste of bonds, and we'll do some more in the future, but with this, I'd encourage you to get an early look at the homework assignment, because historically, bonds has been something that students have struggled to understand and been able to calculate. So if you get started now and you want to check your answers with me, I'd be glad to have you do that. Any questions about this example before we move on to unrecovered investment balance? Okay. So the idea of unrecovered investment balance is, what if you decided you wanted to own a food truck? And so what you did was you spent a bunch of money now to buy the food truck, buy the equipment inside, and a typical food truck cost, I looked up online, $85,000 is kind of a baseline food truck cost. And let's say that you're going to be selling hot dogs for $8.50 each. And this is an actual food truck that sells hot dogs, and it's not one around here. I don't think people would pay $8.50 for a single hot dog. This must have been someplace fancy, like Charlotte, North Carolina, or Portland or something. But the question is, how long is it going to take you to pay off the food truck when you have a certain amount of revenue coming in each year? You've got this lump sum outflow, and when you have money out that you haven't yet recovered profits on, that's called unrecovered investment balance. So what we want to do in this activity is calculate at the end of each year what's the unrecovered investment balance. And the way it works is that initially there's a certain amount of money that you've paid out, and of course outflows we usually represent as an arrow that's down. And so outflows are down. But here, this whole diagram, by definition, it's saying unrecovered investment balance. And so it's understood that it's money you've paid out that you haven't yet got back. So it's okay for us to have that above the line because, the title is implying it's an outflow that hasn't yet been recovered. This initial investment grows during the first period because of the effective interest. So it's money that you paid for the food truck, you could have just put into the bank and earned money on that. So whatever your rate of return that you're hoping to achieve, this initial unrecovered investment balance is even higher by the end of the first year. But then you have a certain amount of revenue minus expenses. And so the profit, in other words, brings down the unrecovered investment balance a certain amount, and then it grows during the second year, and your profits for that second year bring it down. So sometimes our question is, how long is it going to take for us to break even? How long until we finally got the money back that we originally paid to begin some sort of a business opportunity? So a figure like this can help us to calculate the break even. The internal rate of return is the name for a certain interest rate that's going to bring balance between the inflows and the outflows over a period of years. So at the end of a study period, the internal rate of return is the interest rate that brings the balance to exactly zero. So keep that in mind. We're going to be talking about lots of different interest rates over the coming lectures, and internal rate of return is the one that makes the inflows and the outflows equal after n periods. Okay, so this is the template file that I gave you for the second problem that's on the back side of the paper. So on the back side of the paper, it tells us that today we're going to receive $85,000 from the bank for a 5-year loan so we can buy that food truck. And it's 4% annual interest, so it's only compounding once per year. And in part A, it's just sketch the cash flow diagram of what that looks like, where you get $85,000 now, and then you pay out some unknown A over time. And then I've given you the factor for the A/P. And so on your handout, it's a little different from what's shown on the screen here. Let me type what is the ratio of A to P. So A/P, I can't see that, is it white text? All right, A/P for I equals 4% and N equals 5. The factor there is 0.2246271113. So with that factor, calculate what's the amount that you have to pay the bank each time. And then I've given you some formulas for your column. You notice that each one of these columns has a number. Column 1, column 2, column 3. Here are the formulas that you should use to calculate each column. And what you'll see is the unrecovered principal balance over the course of a year is going to go down to 0. It'll start, your starting unrecovered investment balance is $85,000. But what we should see is that at the end of the 5-year period, because of the payments that you're making, it'll bring the debt back to 0. All right, so let me pause for a moment, give you a chance to start mulling over. First of all, calculate the repayment amount, how much you have to pay back to the bank, because that's going to go into column 4. What you should notice is that this matches the figure that I showed you earlier. Let's see, where's that figure? This one. So what that's showing is that, let me drag this down here. Okay, the first year, at the beginning of the year is times 0. So here where it says year 1, that means the first year that you're doing the thing. So the beginning of that interval is here at times 0, and you've got this balance of $85,000. And then during the year, the interest is 4% of the balance. So in each successive year, the interest amount is less because the balance of the loan is less. So you don't have to pay the same amount of interest each year to the bank. You're just paying the interest on the balance that you haven't yet paid back. And so then the balance loan at the end of the year, so year 1, the start of the year is at times 0. The end of the first year is here at this tick mark. And so the balance of the loan is the original amount plus the interest that's accumulated during that period. Just for purposes of convenience, we're always paying the bank back the same amount each year, even though the interest rates are different. And so then what that means is that an increasing amount of our payment is going towards the principal in each year. And this is sometimes why people, when they're buying a home, if you want to make double payments to the bank, if you want to make your loan so that it finishes early, it makes more sense to pay as much early in the process as you can, because then it'll bring down the amount of years that you're paying interest on the total balance of the loan. So you notice towards the end we're looking for it to go to 0, and it doesn't go exactly to 0. That's because I just did it to the nearest penny here. So $19,093.30. I think that some of you were doing fractions of pennies, and you eventually did get it to go to all the way to 0. I think in reality what they'd have you do is just that last payment would be a little bit more. And so there's no such thing as paying fractions of pennies. So if you really wanted to go to 0, then this year we'd do $19,093 and 33 cents, and then that would bring it down to 0. So we'll revisit this idea again in the future. This was kind of looking at it from the viewpoint of what if you were borrowing money, what would that loan look like over time? It's the amortization of a loan. But we have the same exact calculations if you're trying to figure out if it's your own money rather than borrowed money. You know, what's happening when you are expecting a certain rate of return? How long will it take you to pay off the loan at that rate of return? So save this file So you have that as a reference. Be sure and hang on to the in-class exercise paper. I think that the bond calculations we did on paper earlier in the class will help you with the assignment. So just taking one last look at these announcements. Remember, the assignment's not due till Monday, but bonds are fresh in your mind right now, so it'd probably be most efficient for you to start on those calculations sooner rather than later. All right, I'll see you on Wednesday.